Here's a question that might keep you up at night. Why do you work harder than your grandparents ever did, yet you're further from owning a home than they were at your age? Why does a chocolate bar that cost 50 cents in the year 2000 now cost $2? Why does your salary increase feel meaningless when rent, groceries, and gas eat it all away? The answer isn't what most people think. It's not about working harder. It's not about making smarter choices. And it's definitely not about drinking less coffee. The answer is hiding in plain sight, printed on every dollar, pound, and euro you've ever held. There's an invisible system, a machine that's been quietly transferring wealth from your pocket to someone else's, and most people will never understand how it works. Until now. Let's start with something simple. What is money? If you're like most people, you probably think money is something you earn by trading your time, your skills, your effort. You work 40 hours a week, and your employer gives you money in return. That money represents the value you created. For thousands of years, this made perfect sense. Money was gold, silver, or something tangible. If you had a gold coin, you had real wealth in your hand. It couldn't be created out of thin air. It couldn't be printed endlessly. Its value was real. But something changed, something fundamental, and most people missed it entirely. In 1971, U.S. President Richard Nixon made an announcement that would alter the course of human economic history. He severed the link between the U.S. dollar and gold. This event, known as the Nixon shock, meant that for the first time in modern history, money was no longer backed by anything physical. Money became an idea, a promise, a piece of paper whose value was decided not by what it represented, but by how much of it existed. And here's where everything changes. Because when money is just paper, or more accurately, just numbers in a computer, it can be created infinitely. And when something can be created infinitely, the rules of the game change entirely. There's a part they don't teach you in school. When you deposit $100 into your bank account, you probably think that money just sits there, waiting for you to withdraw it. But that's not what happens. The moment you deposit that $100, your bank is legally allowed to lend out $90 of it to someone else. That person deposits the $90 into their account. Their bank then lends out $81. That bank lends out $73, and on it goes. From your original $100, the banking system has just created over $900, not by printing it, not by earning it, but simply by lending the same money over and over again. This is called fractional reserve banking, and it's perfectly legal. In fact, it's how the entire modern financial system operates. But here's the catch, the part that changes everything. All that new money, it didn't exist before. It was created the moment someone borrowed it. And every single dollar created this way comes with something attached to it. Debt. Let's talk about debt for a moment. Not in the moral sense, whether it's good or bad to borrow money, but in the mathematical sense. In our current system, nearly every dollar in existence was created as a loan. Someone, somewhere, borrowed it into existence, which means that for every dollar that exists, someone owes a dollar plus interest. Now, here's the impossible part. If all money is created as debt, but you have to pay back more than you borrowed because of interest, where does that extra money come from? It doesn't exist. This is the fundamental flaw, the invisible trap built into the system. The total amount of debt in the world will always be greater than the total amount of money available to pay it back, which means someone, somewhere, must always default, must always lose, must always go bankrupt. Between 2008 and 2012, during the global financial crisis, over 10 million families in the United States lost their homes to foreclosure. But here's what most people don't realize. Those foreclosures weren't accidents. They weren't anomalies. They were features of the system, working exactly as designed. Now, let's talk about inflation, the silent thief that steals from your wallet every single day. You've probably noticed that things cost more than they used to, a lot more. And you've probably been told this is normal, that a little bit of inflation is healthy for the economy. But what if I told you that inflation isn't a natural phenomenon? What if it's a direct result of the money creation system we just described? Think of the economy as a balloon. When you create more money but don't create more goods and services, you're pumping more air into the same balloon. The balloon gets bigger, but nothing inside it has actually changed. In 1970, the median home price in the United States was $23,000. Today, it's over $400,000. Did houses become 17 times better, 17 times bigger? No. The money supply expanded. In 1970, there were roughly $200 billion in circulation. Today, there are over $21 trillion. But here's the cruel part. While the money supply increased by more than 100 times, average wages increased by only 8 times. The gap between these two lines represents the largest wealth transfer in human history, and most people never even noticed it was happening. There's an economic principle that most people have never heard of, but it explains almost everything about wealth inequality in the modern world. It's called the Cantillon effect, named after an Irish-French economist named Richard Cantillon, who discovered it in the 1700s. Here's how it works. When new money enters the economy, it doesn't reach everyone at the same time. It flows like water from a broken dam. The people closest to the source get it first, and by the time it reaches the people at the bottom, its purchasing power has already eroded. In our modern system, new money is created in one of two ways. The central bank, the Federal Reserve in the US, the Bank of England in the UK, or the Reserve Bank of Australia, creates it and gives it to commercial banks. Or commercial banks create it themselves by issuing new loans. Either way, the people who get this new money first are banks, large corporations, and the wealthy individuals who have access to cheap credit. They use this freshly created money to buy assets, real estate, stocks, bonds, businesses. And because they're buying these assets before the new money has caused prices to rise everywhere else, they get them at a discount. By the time this money trickles down to regular workers in the form of wages, prices have already increased. The grocery store has raised its prices. The landlord has raised the rent. The value of your salary has been quietly diluted. This is why the rich get richer even when they're not doing anything productive. They're simply closer to the money printer. Between 2020 and 2021, during the global pandemic, the world's billionaires increased their wealth by $5 trillion. Not because they worked harder, not because they created more value, but because governments created trillions of dollars in new money, and that money flowed to them first. Meanwhile, ordinary workers saw their savings eroded by the highest inflation in 40 years. Let's talk about housing, because this is where the wealth transfer becomes impossible to ignore. In 1971, the year the dollar was disconnected from gold, the median home in the United States cost about $28,000. The median household income was around $10,000. That means you could buy a house for roughly 2.8 times your annual income. Today, the median home costs over $400,000, while median household income is about $75,000. That's more than 5 times your annual income. Back in 1971, if you saved diligently, you could actually save up enough to buy a house with cash within a decade. Today, even if you save aggressively, home prices are rising faster than you can save. In cities like Toronto, Sydney, London, and San Francisco, homes are now 10, 12, even 15 times the average annual income. An entire generation has been priced out of home ownership, not because they're lazy or irresponsible, but because the money system itself creates asset inflation faster than wages can possibly keep up. And here's the trap within the trap. Because homes are unaffordable, people are forced to take on massive mortgages, 30-year debts that will cost them 2 to 3 times the purchase price of the home by the time they're paid off. Let's say you buy a $400,000 house with a 30-year mortgage at 5% interest. By the time you've paid it off, you will have paid the bank over $770,000. That extra $370,000, that's wealth transferred directly from you to the financial system. Money you earned through your labor, your time, your life, handed over simply for the privilege of having a place to live. Multiply that by millions of homeowners, and you begin to see the scale of the wealth extraction machine. But housing isn't the only trap. Let's talk about education. In 1980, the average cost of a 4-year degree in a public university in the United States was about $10,000 in total. You could work a part-time summer job and pay for most of your education without taking on debt. Today, that same degree costs over $100,000. And unlike in 1980, wages for entry-level jobs haven't increased at anywhere near the same rate. So young people are faced with an impossible choice. Don't go to university and struggle to find well-paying work in an economy that demands degrees, or take on crushing debt that will follow you for decades. In the United States alone, student debt has surpassed $1.7 trillion. That's more than the entire GDP of Canada. But here's the question nobody asks. Where did all that money go? It went into the pockets of an education system that expanded its administration, built luxury facilities, and raised prices because they knew students would borrow whatever amount was necessary. They knew the money would be created by banks, loaned to students, and the students would spend the next 30 years paying it back with interest. Once again, wealth flows upward. Once again, regular people are trapped in debt. Once again, the system is working exactly as designed. Let's bring this all together with a thought experiment. Imagine you earn $50,000 a year. You work hard, you're responsible, you try to save. But here's what's really happening to your money. Inflation quietly steals about 3% of your purchasing power every year. That's $1,500 gone just from holding your money. You're paying income tax, let's say 20%. That's $10,000 to the government. You're renting because you can't afford to buy. That's $15,000 a year to a landlord who bought the property with cheap credit created by the system we described. If you have a car loan, student debt, or credit card debt, you're paying thousands more in interest every year. By the time you've paid for groceries, utilities, transportation, and basic necessities, all of which have been inflated by the expanding money supply, you're left with almost nothing. You're not poor because you're bad with money. You're poor because the system is designed to extract wealth from your labor and transfer it upward. You're running on a treadmill that speeds up every time you start to get ahead. Here's what makes this even more heartbreaking. It didn't used to be this way. In the decades following World War II, a single income could support a family of 4. A factory worker could buy a house, own a car, send kids to university, and retire with a pension. Was that generation smarter? Did they work harder? Were they more responsible with money? No. They lived in an era when the money supply was more stable, when wages could actually keep pace with the cost of living, when asset prices hadn't been inflated beyond reach by decades of money creation. Today, both parents work full-time jobs and they still can't afford what their grandparents had with a single income. They're told to budget better, to stop buying lattes, to work side hustles. But the math doesn't work. No amount of personal responsibility can outrun a system that creates money for the wealthy while extracting it from everyone else. Now, here's where things get interesting. The people running this system aren't villains in a movie. They're not sitting in dark rooms plotting to make you poor. In fact, most of them genuinely believe they're helping. Central banks will tell you they create money to stimulate the economy, to prevent recessions, to keep people employed. And to some degree, they're right. When the economy is in crisis, like in 2008 or 2020, injecting new money into the system can prevent total collapse. It can keep businesses running and people employed. But here's the paradox. Every time they do this, they make the underlying problem worse. They inflate asset prices further. They push homes and investments further out of reach for ordinary people. They increase the wealth gap. They're trying to fix a fire by pouring gasoline on it. And what happened? Housing prices soared to record highs. Stock markets reached all-time peaks. Billionaires became richer than ever. Meanwhile, ordinary workers faced the worst inflation in 4 decades. But if you think this is bad in wealthy countries like the US, UK, Canada, or Australia, imagine what it's like in the rest of the world. When the US Federal Reserve creates trillions of dollars, it doesn't just affect Americans. Because the dollar is the world's reserve currency, the currency used for international trade, American monetary policy affects the entire planet. Countries that trade in dollars suddenly find their own currencies weakening. Their imports become more expensive. Their citizens get poorer, not because of anything their own government did, but because a central bank on the other side of the world printed money. In Argentina, inflation reached over 100% in 2023. In Turkey, it exceeded 60%. In Lebanon, the currency lost 90% of its value in just 3 years. These aren't just statistics. These are real people who watched their life savings evaporate, who went to bed middle class and woke up poor. And the cruel irony? Many of these countries were forced into this position because they took on debt denominated in US dollars. When the dollar strengthens due to US monetary policy, their debt becomes impossible to pay back. The invisible system doesn't just make individuals poor, it makes entire nations poor. So if the system is broken, what's the alternative? In 2008, right in the middle of the global financial crisis, an anonymous person or group using the name Satoshi Nakamoto published a 9-page document describing a new kind of money. It was called Bitcoin, and it was designed to solve one fundamental problem. No one could create more of it at will. Unlike dollars, pounds, or euros, Bitcoin has a fixed supply. Only 21 million Bitcoin will ever exist. No central bank can print more. No government can inflate it away. Now, this isn't an advertisement for Bitcoin. Whether it succeeds or fails as a currency is still an open question. But what's interesting is what it represents. It's a response to the broken system we've been describing. It's millions of people around the world saying, we don't trust you to manage our money anymore. Since Bitcoin was created in 2009, the US dollar money supply has increased by over 400%. Meanwhile, Bitcoin's supply has grown exactly according to its predetermined schedule, approaching its 21 million limit. The experiment raises a profound question. What if money didn't have to be controlled by governments and banks? What if there was a form of money that couldn't be inflated away, couldn't be manipulated, couldn't be used to transfer wealth from the poor to the rich? We don't know yet if Bitcoin or any cryptocurrency is the answer, but the fact that hundreds of millions of people are looking for an alternative tells you everything you need to know about how broken the current system is. So what do you do with this information? How do you protect yourself from a system designed to extract your wealth? The uncomfortable truth is you can't completely escape it. You live in this economy. You use this money. You're part of this system, whether you want to or not. But you can understand it, and understanding changes everything. First, recognize that holding cash is a guaranteed way to lose purchasing power. The inflation we've described will erode your savings by 3 to 5% every year, sometimes more. The wealthy don't hold cash, they hold assets, things that tend to increase in value as the money supply expands. Real estate, stocks, businesses, precious metals, even art and collectibles. This doesn't mean you should gamble your savings on risky investments, but it does mean that you should understand that saving money in a bank account is not the safe choice it appears to be. Your money is guaranteed to lose value over time. Second, be extremely cautious about debt, especially consumer debt. Remember, every dollar of debt you take on is a transfer of your future wealth to the financial system. Credit cards charging 15 to 25% interest are designed to keep you perpetually in debt. But also recognize that not all debt is equal. The wealthy use debt strategically, borrowing cheap money to buy assets that appreciate faster than the interest rate. This is how they benefit from the system. The poor are sold debt to buy depreciating consumer goods, cars, electronics, vacations. This is how they're trapped by the system. Third, and most importantly, educate yourself. The reason this system continues to work is because most people don't understand it. They don't know how money is created. They don't understand inflation. They don't realize they're on a tilted playing field. The system relies on your ignorance. Learn how money works. Learn how the banking system operates. Learn about assets and investments. Learn about monetary history. Teach your children these things because they certainly won't learn them in school. The education system, like most institutions, has little incentive to teach you how the economic system really works. It benefits from you staying confused, staying compliant, staying in debt. Financial literacy isn't just about personal success, it's about freedom. It's about understanding the invisible chains so you can learn to break them. But here's what's really at stake, something bigger than personal wealth. This system doesn't just make people poor financially, it makes them poor in time. Your grandparents might have worked 40 hours a week and had enough. Today, people work 50, 60, 70 hours. They work second jobs, side hustles, gig economy work. Not because they're more ambitious, but because the system requires more labor to achieve the same standard of living. That's time you don't spend with your children, time you don't spend pursuing your passions, time you don't spend living your life. The invisible money system doesn't just steal your wealth, it steals your time, it steals your life. So, can this system be changed? That's the trillion-dollar question, literally. Some economists argue for returning to a gold standard or some form of commodity-backed money. Others advocate for strict limits on money creation. Some believe in completely decentralized currencies like Bitcoin. The truth is, any meaningful change would require rewriting the fundamental rules of the global economy. It would require central banks to give up power. It would require governments to accept constraints. It would require the financial industry to sacrifice its privileged position. None of those groups have any incentive to change the system that benefits them. But history teaches us something important. Unsustainable systems eventually break. When governments create too much money for too long, confidence eventually collapses. We've seen it happen dozens of times throughout history. The Roman Empire debased its currency and fell. The Weimar Republic printed money and triggered hyperinflation. Zimbabwe destroyed its currency through money printing. Today, global debt is higher than it's ever been. Money creation is faster than it's ever been. Asset prices are more inflated than they've ever been. Something has to give. Here's what you need to understand as we close. You are not imagining it. The game is rigged. The system is extracting your wealth. Your struggle is not a personal failing. It's a mathematical certainty built into how modern money works. But you're also not powerless. Understanding the system is the first step toward navigating it. Knowing how money is created, how inflation works, how debt traps function, this knowledge is power. You can make different choices. You can protect your wealth. You can refuse to play by rules designed to make you lose. You can teach others. You can demand transparency. You can support systems and technologies that offer alternatives. The invisible system only works because it remains invisible. The moment you see it, everything changes. Your grandparents didn't need to be financial experts to live comfortable lives. They didn't need to understand monetary policy or invest in assets just to maintain their purchasing power. They lived in a different system. You don't have that luxury. You were born into an economy where understanding money isn't optional, it's survival. That's not fair, but it's reality. The good news is, once you understand how the invisible system works, you can't unsee it. And once enough people see it, the system can no longer function the same way. Change starts with awareness. Awareness starts with conversations like this one. The invisible money system has been making people poor for decades. But invisible things can be exposed, and exposed things can be changed. The question is, what will you do with what you now know?